Good morning, good afternoon, good evening, folks. Michael Zubert, one rental at a time. Back with good friend of the channel, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you today?
I'm doing really well. If people haven't watched Greg's playlist, you really do. So, folks, Greg has a playlist with over 100 hours of interviews. One of the things you will see in several interviews is Greg Dickerson and I both credit Rich Dad Poor Dad, that the original book, with kind of changing our future trajectory. It has also been said many times that I read it and think about being Robert, and he reads it and wants to be Rich Dad, which still cracks me up to this day. I read it recently and I still want to be Rich. I still want to be Rich, or I want to be Robert and Kim. I just don't have it. But the reason I wanted to talk to you today is because we really do internalize and receive information differently, which I appreciate so much. So I wanted to talk about the Fed. I think it is now without question, the Fed acknowledges that they're behind. They do acknowledge that they probably need to take some aggressive moves, meaning half a basis point or 50 basis points in the next couple of meetings. But I'm reading different arguments. I have one from BlackRock, which I'll share, and one from Goldman, which I'll share in a minute. But as we get started, do you think the Fed, do you agree that the Fed knows they're behind, or do you think maybe they think something else?
No, they absolutely know that they're behind. The other thing that they know that they're trying to correct is that they've lost their credibility when it comes to inflation. So they know that they have zero credibility. And what does that mean? So that means that central banks, governments, and investors around the world have no faith in the Fed, that they fully understand, comprehend inflation and the full effects of it. And like we've been saying for the last few weeks, a lot of people thought that I was crazy when we had that little relief rally.
Yeah.
When I said the markets have not priced in inflation and they have not priced in rate cuts. But more importantly, even now with the recent pullbacks, we still have not priced in the effects of inflation and Fed hiking and monetary policy moving forward. So,
Yeah,
I got a lot of feedback on that. People saying, oh, it's fully priced in, you're crazy, look at the bounce and all that. And like, okay,
no,
we'll see.
Yeah, no. And again, I get a lot of, I get some hate and a lot of feedback, and it's really the buy the dip crowd. Like, there's a certain set of folks who have been trained. You have learned this because it's worked for 2 years. I believe personally, the smart money, when you look at flows, has started to catch religion. It takes a while from the exit positions, but I believe without question that the smart money is getting out or getting defensive, and that there's a large haircut ahead in the overall indices and markets because of the Fed.
So the Fed has to break the markets to correct, course, and to correct inflation, to gain credibility. And the narrative out there, the Fed is totally reverse course in their language and their messaging, totally opposite of where it was. And the investor community is still saying, the Fed's going to reverse course. Fed's going to reverse course. So the talk now is, it's not how far are they going to go, it's how quickly are they going to reverse, which is interesting.
Yes.
So, that's that buy the dip mentality. And yeah, there's a lot of people out there that if you say anything other than, it's going straight up forever, they get all bent out of shape and, want to fire off at you. And
yeah, they do. Yeah.
And, where that's coming from is people that have risked their life savings. They've risked too much. They're losing money. That's where that comes from. It's people under pressure. And I understand it. They're mad because they're losing money and they feel like, people are putting salt on the wound when you say that, but that's not what we're doing. What we're talking about is risk, managing risk, and understanding good times never last, bad times never last. There's peaks and valleys. Now pullbacks and certain economic conditions can last several years if you're not careful. So that's why we talk about risk and risk management, because we've been through, several cycles in our career, especially in real estate. And, you want to make sure that, again, you understand the peaks, you understand the tops, there's nothing wrong with going to cash at certain points and then take advantage of the dips and buying in at the bottoms. And, unless you're a day trader or something like that, then you can, make more consistent moves. But if you're going to play the diamond hands, hodl thing, stuff, doesn't always and forever go up in perpetuity. Some stuff goes away. Some stuff goes to zero, when you're investing in equities and things like that. When you're investing in real estate, I mean, there's certain markets that, crashed and never came back, and then there's some that, do go up forever. So you just gotta, understand risk, manage it, and be able to, calculate it. And then when it happens, be able to withstand the hit if and when it happens.
Yeah. So this is awesome because you and I are on the same page on this one. There's two camps brewing, and I actually read two articles from two different firms I respect. We'll go to BlackRock first. I actually read the BlackRock article this morning. BlackRock basically is in the buy the dip camp. As I read it, basically they're saying, in short, the Fed's going to aggressively move the next two meetings. They're going to get the funds rate over 1, which will be 1.25, right? Excuse me. And then they're going to start to pause. And BlackRock already thinks that they're going to have to start cutting next year. Basically, their article, without saying the word transitory, they believe that inflation is a lot more transitory and it's about to all unwind and deflation is going to take over and this, that, and the other. I think that's a very dangerous strategy. Obviously, they have a lot of money. I think trillions of dollars. I think they're the largest money manager on the planet. And on the opposite side, you got Goldman Sachs, kind of the top tier, Wall Street firm. They're saying that the Fed's going to have to go higher than the market expects. Goldman actually called for 4%, which is the exact number I called weeks ago in 2023. I think they're going to get to 2.75 or 3% this year, and then 4% next year. So when you think about all of this, do you think there's a chance the Fed goes up and then comes right back down, or do you think they have to break it, bash it, pulverize it, and maybe get up to 4%? What do you think?
I think they're going to go up first. So they're going to go as far as they can until something breaks. And, once that's something that breaks, and when I say something, either a huge sell-off in the markets, a credit crisis, the repo market cracks or something like that. Again, like we saw, like 2018.
Yeah, they break the buck on the money market fund or something.
Yeah. So I think they're going to push until something breaks. They're going to push as far and as fast as they can until something breaks. And I think they're willing to sacrifice the markets to curb inflation. So they're going to push the markets as far as they can push. And I think they'll allow up to, from all-time highs recently where we came from, probably a 30% contraction before they'll step back in.
Yeah.
Because that puts you back to the mean, right? That's a reversion back to mean. If you cut 25, 30% off of where we just came from, I think they will tolerate and allow that. And you also have to understand these individuals that are talking, who are their clients, who are they talking to, and where are they coming from? So BlackRock has a very different clientele than Goldman.
Absolutely.
And, how do they make their money, right? So, they're talking to protect their bonuses. So,
of course,
they don't want money to leave their funds. And then you look at like a Kathy Wood that's just been, throwing all the cards on the table and rolling the dice, saying everything's going to go 10x because it's innovation.
Yeah.
She's having to backtrack, and she's unloading some of her innovations that were supposed to 10x and never come backwards and never go down. So, you need to understand who the messenger is, what their agenda is, and who their audience is they're speaking to. Then you qualify the information from there. And there's probably a little bit of truth in everything. And then there's obviously the bias in a lot of it as well.
Yeah. Again, I agree with you. I think the Fed's going to go until it breaks. I actually think they're going to go one meeting past broken, because I think they're going to want to validate that it's broken. I think we just haven't had inflation like this since the 70s and early 80s. And as we're hearing, right, Lennar Brainerd, I forget her first name. I think that's it. She basically came out. She was the largest dove, and then last Wednesday or Tuesday maybe came out and said, "Hey, it's inflation is so bad, it's almost like not having a job, right? The average American is spending an extra $3,000 a year when we already have 64% of Americans living paycheck to paycheck. It is not good." So yeah, I think the Fed, for the first time in my investing life, is going to choose Main Street over Wall Street. And again, the buy the dip crowd doesn't want to hear that. It's an
election cycle we're coming into. So the next 2 years, it's all about, the election cycle. And, people are feeling the pinch now, and they're cutting back. And there were studies that were out recently in polls, even the wealthier, top 1% is starting to cut back, because
I saw that.
Yeah. People are feeling it. It's real. Some of it is going to be transitory, right? So as soon as, the pandemic's over, obviously in Europe, China, they're still locking down and dealing with it. So that's creating some issues. But, as soon as that's done and over with and behind us and supply chains fully open back up, that's going to alleviate some of that pressure. But the labor market hasn't corrected. So wages are still going up. I mean, I saw the other day, Walmart's paying $110,000 a year for truck drivers.
Yeah. And I actually talked to a trucking coach. It's a 4-week course. 4 weeks. You have to be 18 for in-state. And I asked these questions because it's a crazy salary. You have to be 18 to drive in-state, 21 to drive across the country, I guess, across states. You can make 110 grand starting to drive for Walmart. Damn.
Who's paying for the classes though? Because I heard that it was hard to get into the classes because they didn't have enough instructors or something like that.
Yeah, there is a lot of demand. The courses on average are $5 grand. Some states are 7, so they're not that expensive. Right now, I'm guessing it's individual. I didn't ask who pays.
Yeah, and I bet you the company would. I bet you the company.
I bet they would.
We'll pay for it. Go get your training. We'll cover that. And then you're seeing bonuses for, other employers are offering sign-up bonuses and sign-on bonuses.
They're paying bonuses
is offering
to show up to the interview. You get $50 just to show up.
And now you have food. So poultry, obviously, with the bird flu, and then you have the grain situation going on, and the wars creating global food shortages. So you're going to see commodities continue to go up. Fuel, we'll see how that shakes out at the end of the day with what's going on. Oil's, up and down. But, so some of this stuff is transitory. Some of it, is going to alleviate at some point, but some of it's permanent and it's here to stay. So the only way you correct is you have to destroy the demand for those products, because we are a consumer-based economy globally. And we're also experiencing some deglobalization. The war is creating some of that. That's going to drive prices up that aren't going to come back. So it's a very unique time. There's no other time in history where you can open a textbook and say, okay, well, here's what happened then, even the 70s. You just can't compare anything to any point in time back then, because it's we're very differently from a global economy now than we were back then. The technological revolution, the internet revolution, and the services-based industry, skill-based industry is totally different than it was back then. So, it's very unique.
Yeah. Man, lots of great stuff. I appreciate this conversation. Again, I think the Fed's got religion. I think they are going to take Wall Street. If it's 30, 40%, I think there's some pain coming. So be prepared. Look at your portfolio, see what's going on. If you don't have to sell and you want to wait, it's okay. It'll come back, but yeah.
Yeah. Now, no, I don't think anybody's calling for that. I'm just saying, I believe they'll let it go that far if we do start to see major correction territory. I called for initially about a 10% drop from where we were a couple of weeks ago. So we're not quite there yet, but back to about that, we're going to check that bottom that we had in the recent sell-off again before we can look for any kind of a bounce or continuation down.
I think that was 4,100 on the S&P or something like that.
Yeah.
So a lot of great stuff. I appreciate everything you do. You have an amazing YouTube channel and website. What is it?
Yep. GregDickerson.com. That's where you can find me. All my YouTube channel, social media links, all there. GregDickerson.com.
Thanks, buddy.